Trump's tariffs on China have escalated to 104%, prompting China to retaliate with 84% tariffs on U.S. goods. Additionally, China is considering selling its U.S. Treasury bonds, which could destabilize the U.S. economy and financial markets. This escalating trade conflict raises concerns about a potential global recession and impacts on both economies. China has significantly increased tariffs on U.S. goods to 84%, prompting a strong response from President Trump with additional tariffs. This escalation in trade tensions could destabilize global financial markets. The potential selling of U.S. Treasury bonds by China could lead to increased financing costs for the U.S. This move is seen as a significant retaliatory action. The current circumstances have caused panic in the U.S. stock markets, reflecting the fear of economic repercussions from the escalating trade war. Investors are closely monitoring these developments. Experts warn that excessive selling of bonds could lead to a depreciation of the dollar and increased inflation rates. The situation poses a substantial threat to the U.S. economy. China's potential decision to stop buying U.S. dollars indicates a strategic shift away from dollar assets amid rising tensions with the U.S. This could profoundly impact the global financial landscape. The dramatic sell-off in U.S. Treasury bonds has raised yields and caused turmoil on Wall Street, reflecting the uncertainty in financial markets. This scenario is driven by escalating trade tensions. China's strategy may involve diversifying its reserves and developing alternatives like the digital yuan to mitigate risks associated with U.S. sanctions. This reflects a long-term financial orientation. Panic selling in bond markets suggests that investor sentiment is deteriorating, fearing rising interest rates and inflation due to a potential Chinese bond sale. This could destabilize the U.S. economy. The trade tensions between the U.S. and China are escalating, potentially leading to significant financial repercussions globally. Economists predict that these conflicts could trigger a recession if not managed properly. Experts warn that a sudden sale of China's U.S. bonds could destabilize the dollar and lead to increased interest rates. This scenario poses risks for both economies involved. China may consider reducing its reliance on U.S. bonds by diversifying its currency investments. Such a shift could significantly impact the U.S.'s global financial dominance. The historical context reveals that trade conflicts often precede economic downturns, drawing parallels to the 1930s and the Great Depression. This raises concerns about the current situation's severity. The escalating U.S.-China trade tensions are threatening the stability of the bond market, raising concerns about potential long-term economic repercussions. A significant bond sell-off by China that could trigger a global financial crisis. Rising bond yields are increasing U.S. borrowing costs, which may lead to inflationary pressures and a potential recession in 2026. Analysts warn that this could destabilize the U.S. economy. China's response to U.S. tariffs includes imposing high tariffs on U.S. goods and reducing its dollar position, indicating a deeper economic conflict. This back and forth is contributing to a breaking point in trade relations. The bond market's turmoil could also impact the U.S. housing market by raising mortgage rates and reducing housing demand, which exemplifies the interconnectedness of global financial systems.